China didn't just play the game, it changed the rules. While Washington was firing off tariffs, Beijing was busy drafting the blueprint for a new global order. Quietly, it signed the largest trade pact on Earth, $25 trillion in GDP, over 2 billion people, and not a single U.S. signature on the page. The Gulf began selling oil outside the dollar. Southeast Asia started running on Chinese tech. In the West, watching from the sidelines, increasingly locked out. This wasn't about bricks and bridges. It was about speed, scale, and system control, and it's already live. If you still believe America commands global trade, you missed what just erupted in Kuala Lumpur. Because China didn't just attend the Kuala Lumpur Summit, it led it. While the U.S. spiraled into tariff wars, Beijing quietly assembled a coalition spanning ASEAN, the Gulf, and its industrial core. A trade bloc nearly matching the U.S. and EU combined, involving over 2.15 billion people, built while Western media barely blinked. Bloomberg reports ASEAN's internal trade jumped 9.4% in early 2025, with exports to the Gulf soaring 13%. The shift is silent but seismic. Malaysia's Prime Minister called it convergence, not confrontation. Former Ambassador Mohammad Nasri put it plainly, China is filling the vacuum the West left behind, not with weapons, but with coordination. And the data backs it. According to the IMF, China, ASEAN, and the Gulf now drive over 55% of global GDP growth. ASEAN-China trade hit $982 billion in 2024. ASEAN-Gulf trade surged 60% above pre-pandemic levels. Meanwhile, Vietnam's exports to the U.S. collapsed 27% under new tariffs, while its imports from China rose 14%. Indonesia lost 5 years of surplus gains in one quarter. Across the region, nations are pivoting, not loudly, but unmistakably. At the heart of this shift is ACFA 3.0, China's upgraded trade pact covering not just goods but digital commerce, ESG standards, and green energy, areas where U.S. involvement has been minimal or reactive. As James Chin of the University of Tasmania said, China's been handed the mic. The U.S. isn't even in the room. But this isn't just about trade. It's about anchoring influence. The ASEAN Express freight line from Malaysia to Chongqing slashed logistics costs by 17% and rerouted regional supply chains under Chinese control. The Jakarta-Bandung high-speed rail, funded by $7.3 billion in Chinese capital, has already moved over 9 million people. These aren't projects. They're commitments poured in concrete. China is embedding itself in the economic DNA of Southeast Asia, and it's reciprocal. Chinese firms are offshoring to ASEAN to cut costs and sidestep sanctions, creating a deeper economic fusion. Green tech exports to the region are up 19%, driven by joint manufacturing zones. And under the surface, data cables, AI centers, 5G networks, all threading east. The question isn't what the U.S. is building. It's whether it's building anything at all. Then there's the Gulf, where the unthinkable is now routine. Saudi Arabia now settles 30% of oil sales in non-dollar currencies. The GCC has committed to raising ASEAN trade from $130 billion in 2023 to $180 billion by 2032. At the same time, China confirmed it's aligning development strategies across Gulf and ASEAN states, not as bilateral deals, but as a new trilateral architecture. Total Energies signed a yuan-based LNG contract with China, hammering another crack in the petrodollar system that's held since the 1970s. Western analysts ask if the Gulf is drifting, but Beijing's already landed. According to the Financial Times, Gulf sovereign wealth funds are pouring into AI, green tech, and digital finance sectors where U.S. capital has slowed. With China increasingly controlling both trade flows and energy supply, Washington is losing leverage faster than it can replace it. Despite political claims of trade victories, the U.S. under Trump's second term hasn't signed a single binding trade deal. The Phase 1 agreement with China was never ratified. Beijing missed agricultural targets by 28%, and there were no penalties. Meanwhile, U.S. tariffs have cost over $300 billion since 2018, without bringing back large-scale manufacturing. China, on the other hand, is locking in multi-sector, legally binding frameworks, RCEP, ACFA 3.0, and an upcoming China-GCC free trade deal slated for 2026. Even Canada and Mexico, once staples of U.S. trade, are pivoting. Canada's investment in Asia, jumped 11% last year. Mexico is widening its exports to ASEAN. Washington governs by executive order. Beijing builds systems meant to last. Ask yourself this. In a world redrawing its lines, who's truly decoupling and who's simply being left behind? As of 2025, China isn't just exporting technology. It's laying claim to the future's architecture. Huawei doesn't just sell 5G towers. It now runs the core infrastructure of Thailand's telecom backbone. In Singapore and Malaysia, new AI labs aren't private ventures. They're state-aligned, backed directly by China's National Development and Reform Commission. This is no longer commerce. It's jurisdiction building. Bloomberg reports a 28% spike in Chinese digital investment across ASEAN last year, targeted not at gadgets, but at the veins and arteries of digital power, cloud systems, AI infrastructure, and ultra-fast fiber optic lines. These aren't one-off deals. They're deeply embedded, long-horizon partnerships, locked in by 10 to 15-year technology leases, often coupled with sovereign-level data access agreements. China isn't selling tools. It's embedding itself in the operating systems of other nations. When Washington's semiconductor bans hit, China pivoted fast. Its leading AI firms moved compute operations to Southeast Asia, igniting a regional construction wave. Chinese-funded data centers shot up across ASEAN, a 36% rise, according to CBRE, not just as a workaround to sanctions, but as a new digital spine. These aren't just buildings. They are the cloud layer foundation of future economies, where China is now deeply entangled. So, when the next logistics platform launches, when the next national digital currency goes live, when ASEAN's next smart energy grid activates, will it even speak the language of the West? In March 2025, something happened that didn't make front-page headlines, but should have. China and Total Energies executed the world's first LNG trade fully in yuan. No dollars, no middlemen. Just Beijing and Paris settling energy in a Chinese financial system. It wasn't symbolic. It was foundational. Bloomberg now projects that if this trend continues, 20% of global energy contracts could be de-dollarized by 2028. It's already happening. Saudi Arabia has moved nearly a third of its oil contracts off the dollar. The UAE now clears yuan in bilateral trade through China's SIAS system, outside SWIFT's reach, beyond Washington's influence. Energy is the lifeblood of globalization, and China is rewriting how it flows. Indonesia is piloting digital oil payments on Belt and Road corridors. Kazakhstan is deploying AI-managed pipelines. The petrodollar wasn't built for this kind of integration between hydrocarbons and fintech. HSBC notes that global yuan usage in trade settlements has more than doubled since 2020, rising to nearly 8% in Q1 of 2025. This isn't just a monetary trend, it's a structural reconfiguration of power. Because when energy no longer flows through the dollar, what flows through Washington? The Kuala Lumpur Summit didn't end a treaty or a headline-grabbing handshake. It ended with a blueprint. ASEAN, the GCC, and China agreed to fast-track a free trade agreement while upgrading the ASEAN-China Free Trade Area to 3.0, complete with ESG metrics, AI governance, and data law harmonization. Analyst Anari Brown puts their combined GDP at $24.87 trillion, roughly equivalent to the US and EU combined. But this isn't just about scale. It's about legal standardization, shared rules, shared frameworks. A GCC-funded maritime corridor through East Malaysia will bypass not only the Strait of Hormuz, but also US-controlled Pacific choke points, establishing a third axis of global trade outside legacy control zones. Professor James Chin calls this positional cooperation, a new model where legal interoperability replaces old-school military alliances. Former Ambassador Mohammad Nasri was more blunt. China isn't giving speeches. It's writing contracts. And if ASEAN, the Gulf, and China align their standards for arbitration, investment, and tech law, what relevance does the WTO still hold? Vision 2045, ASEAN's roadmap for the next 2 decades, sets goals that would have sounded far-fetched a decade ago. Unified digital economies, harmonized legal codes, region-spanning industrial corridors. But ambition is only half the story. McKinsey says intra-ASEAN trade still lingers at 23%, a far cry from the EU's 65%. Bottlenecks remain. Land issues in Vietnam. Patchy AI laws in Brunei. Fractured digital standards. Gulf sovereign wealth funds are pledging over $50 billion, but uneven governance threatens to slow deployment. Financing is abundant. Coordination is not. And the clock is ticking. A leaked EU Council memo cited by Reuters suggests the ASEAN-GCC-China axis could realign trade across the Indo-Pacific and force Brussels toward digital decoupling, especially if legal frameworks continue to diverge. The stakes are clear. The alliance is real. But the gap between vision and execution, that's the pressure point. That's where the system either hardens or breaks. So if you're still watching BRICS thinking that's the headline act, you're watching the wrong stage. What's happening here isn't a bloc. It's an alternative system. A second internet. A second energy market. A second legal order. It's a new infrastructure for a global economy built on Chinese code, powered by Gulf oil, and routed through Southeast Asia. And the hardest truth of all? If it works, it won't just reduce reliance on the United States. It may render the United States optional. So here's the question. Is this the birth of a parallel world order, or just another summit-built illusion waiting to collapse under its own ambition?